This podcast is for financial professional use only and is not intended for use with the public. Material is for informational purposes only and is not intended to provide tax, legal, or investment advice. The opinions expressed in this podcast are those of the participants and do not necessarily reflect the views of Ash Brokerage. Welcome to Accumulation to Activation, the podcast that breathes life into your retirement planning strategies. If you're an advisor aiming to elevate your practice, deepen client relationships, and stay ahead of retirement income trends, we'll help you capture the opportunities on your doorstep and increase your impact. Each episode, we'll unpack the forces reshaping our industry, from the $44 trillion generational wealth transfer and the evolution of income planning to behavioral shifts, legislative updates, and breakthrough solutions that redefine financial security. Here are your hosts, Mike McLaughlin and Tim Ash.
Hello again, everybody. Welcome to Accumulation to Activation, where we talk about all things retirement income planning, from taking a client's unbelievable nest egg and having worked and accumulated all their life to making sure that they can have an active retirement and one that has a high probability of success. I am joined by my co-host, Tim Ash again. Tim, how are you doing today?
I am doing quite well. It's great to be with you and always great to have our audience and listeners. And we appreciate your feedback. Thank you. We're getting plenty of it. And please keep it coming.
Yeah, thank you to all the listeners. And again, if you like what you hear, please make sure that you like and subscribe this, share the link with people in your office and people within your financial services community. So we appreciate it. We want to wrap up a series that has taken about 5 different episodes, I think, talking about some of the comments or lack of comments inside of the Fisher Investment Annuity Insights report. We really felt like there was some education that we needed to provide to our advisors that can be passed on to clients about some of the use of annuities. And they spend a bit of time talking about returns. And for me, buying an annuity is less about returns and improving the outcome. And you kind of mentioned this in the last episode, Tim, but talk about our focus at Ash Brokerage on outcomes, especially with qualified money, not just retirement income, but the outcome to the family.
I'd be happy to. Well, here's an outcome: running out of money. How does that work? How does that feel? Or having to have a serious decline in the amount of income that you're able to take in your retirement years. That's an outcome. Annuities. So again, let's not talk about financial returns, but let's talk about outcomes. You have this lifetime income stream that's predictable and that you can count on. So no matter how long you live, it's going to be there. And that's the part to me that matters most. So we could talk about, hey, what's this going to return, and what's that going to mean to my other asset allocation, and what about sequence of returns? We take a lot of that narrative off the table. So outcomes to me are, let's have a predictable paycheck in your retirement that you will not outlive, and it's backed by some of the largest financial institutions in America, the largest buyers of bonds, insurance companies. And we're talking about A+ rated and higher companies in the solutions that we recommend. So, to me, why wouldn't you add that to your portfolio? Just a piece of it. You'll never have to apologize for it. Do you recall having conversations in 08, 09 during the financial crisis of having to apologize for returns, even though you had no control over them? You had people worried. And whether it's the financial crisis or the real estate issues, interest rate risk, you name it, this to me is about providing certainty.
Interesting. I was out last week with some of our top producers, and it was a week of volatility. And a couple of them came up to me and said, "You know what? I have not had one client give me a call about the drop in the market." And not all was in fixed index annuities. There's still market exposure, but just that certainty of income, that certainty of the floor, that makes a world of difference for your clients. Just having that security and shifting that risk. I mean, if there's any risk that you can share and shift to an entity like an insurance company, why not do that when it's cost effective? And this is certainly a cost effective way to do.
What do you call? I'm sorry to interrupt you. I like to call an insurance company a partner in owning a bond portfolio.
Yeah, it's the best bond manager ever, right?
It's your bond partner, and they are the ones vetting the largest bond issuances out there. They're the ones managing it. They're the ones saying, "I'm going to provide you with the G." Can a financial advisor use the G word? Guarantee?
No, no.
The insurance industry can use the guarantee word, obviously with caveats, backed by the financial stability and ratings of the insurance company. However, name a time when an annuity payment has not been made in the entire history of the industry.
Yeah, that's not talked enough, Tim. Just through the Great Depression, through world wars, through recessions, no carriers missed a payment. Yeah, now some have gone into receivership, but payments were always made, and other insurance companies bought up those assets and managed those assets appropriately. So, what a great statement about the quality of the insurance industry as a whole, for sure. So, let's talk about returns, because you can't not talk about it. We did a study, and we'll put the one pager in the show notes for you guys to take a look at. But a fixed annuity, I don't even care if it's a fixed index annuity, it is not meant to outpace the S&P 500. It is meant to be a conservative investment vehicle. But so many times, to Tim's point, we're outpacing bonds. Even a multi-year guaranteed annuity outpaces a bond over the last 20 years, looking at 5-year periods. And then you tack on the tax deferred growth of that, it even widens it out. But I know that you have used a lot of MYGAs in a lot of different situations, and talk about the ability to stabilize the bond portfolio, stabilize returns, maybe even especially in a nonprofit scenario.
Sure, I'd be happy to. I'm glad you used the word stabilizer. I call it like a ballast, right? You don't want your boat rocking, especially in retirement. And the stabilizing effect of having a predictable rate of return, and also something that is not going to have a negative interest credit, is very powerful in retirement, because decumulation is the hardest math problem to solve. And so when I look at, is there a way to add like a MYGA? And we've looked historically back, MYGAs have almost always outperformed the 10-year treasury yield, no matter the duration or the time when you acquired it. So let's talk today. We have MYGA rates in the mid fives, and the 10-year treasury right now is 4, just a little bit north of, as we record this. When I look back when the 10-year treasury was hitting 2, we still had MYGA rates that were 3, 3.25, 3.5. Again, it's about, am I able to get a better return safely, provide that stabilizer, and have that just be something that is a part of the is a part of the portfolio. Again, it's a complement. That's all it is. It's not to replace what you're doing with bonds. It's to complement the bond and provide that stability. Tax deferral is certainly something that in a non-qualified portfolio matters. And compounding interest, if you're not taking the interest out and earning interest on interest that's otherwise lost to income tax, uh, that's a powerful thing. And if you have people that are in their 50s or 55 or 60 even that are saying, hey, look, I have assets sitting in non-qual, whether it's in a CD or whether it's in a taxable bond portfolio. And I know most of you that try to do your best to manage taxation on bonds. But here's a way that you can use an instrument that provides that deferral. The nonprofit side of things, because whether it's a family foundation or it could be you have a community foundation, et cetera, the requirement to distribute is 5% of assets. What a great solution to lock in a 5-year, a 7-year, even a 10-year guaranteed rate of return that will always produce that level of payment that must come from the non-for-profit. Some of our largest annuity placements have involved private foundations. And we even helped a publicly traded company that has a foundation. They said, what a great asset allocation for us for part of our portfolio, because we can spit off that 5%. And in fact, we locked in a rate of 5.8% for them. So they even have a little bit of a buffer that the assets inside are not depleting. They're going up while maintaining that 5% distribution. So I'm very familiar with it because I'm involved with a lot of conversations with all of the above, the family foundations, and I work with a lot of RIAs that manage wealth and or assets for them. And they're saying, "Wow, what a great tool! I never thought of using an annuity inside of that." But again, it's using the G word. It's guaranteed.
Yeah, and I think it's super important that where you started that conversation is that insurance carriers can actually manage money better, have a better rate than the current 10-year, because that asset manager that's managing that nonprofit is looking at 4 to 4.1%, the 10-year treasury. And there's other alternatives like a MYGA that can provide that higher rate of return. The reason being that the carriers can actually get out longer on the investment curve because of the pooling effect of all of their money and actually being able to manage bonds on a very cost-effective basis. And I think that's super important for our listeners to really reach out to some of their nonprofits, because today's interest rates are above 5%. It's a guaranteed rate for 5 years for that sleeve, a small sleeve of that nonprofit. Makes for a nice sale and can actually benefit so many people when you're working in the non-profit community. And just generally speaking, nonprofits need a lot of hand holding and awareness of other things. They do a lot of things really well in terms of helping community, but managing money isn't necessarily one of their strong points at the end of the day. So, Tim, there's been a lot of studies out about the positive use of annuities. One is talk about Alliance Bernstein, and then also Roger Ibbotson did something around 2020 talking about the value of indexed annuities as a bond replacement, which I know that you talked a little bit about the previous episode.
Yes, I'll refer to the Alliance Bernstein. They actually partnered and worked alongside of the team at Journey Guide, which is a terrific technology tool that's agnostic to the asset classes that you put within it. And they wrote a very extensive white paper, and what they came up with was that the fixed indexed annuity products, the correct ones, the ones that are priced for the benefit of the consumer, not priced for the payment of high commissions. And that's what we support. We support the ones that are consumer friendly, that produce returns and outcomes that are going to outpace other asset classes. And that's what they found through the study. And we're happy to share that that report that was put out. And we can put that, whether it's in the show notes or you can just reach out to one of your retirement income consultants and get that. But to me, it was very powerful when you have a firm the size of Alliance Bernstein saying, hey, these things called fixed indexed annuities actually work. And this is how you should consider allocating so that you improve outcomes. Now, guess what? When you improve an outcome for a client, it improves the outcome for your business. It improves the outcome for you being referable. All of these things are in place. And also, if you're helping people, the likelihood of you retaining those assets when there's someone that passes away, and it might be a spouse or both spouses, and go to the next generation, these improvements, because if you're doing that for clients, you're going to be thought of in a higher regard. So why don't you talk about the Ibbotson study that was done from around 2020?
Yeah, Roger Ibbotson did a study about the value of fixed indexed annuities in relationship to bonds. And basically, at the vast majority of 10-year periods, FIAs actually outpace the total return on bonds. It's a very eye-opening study for a lot of asset managers relative to the bond market. And again, you're being linked to an equity type of index with no downside market risk. So you're taking away the market value risk of the bond and you're getting upside. And again, we're not saying that that is for the entire portfolio, but we are saying that if there is some risk inside the bond portfolio that you want to take off, this is a great opportunity to sweep some of those gains off of the portfolio, specifically qualified monies because of the tax-free exchange of an IRA rollover, lock in some of those gains, and also from a bond standpoint, outpace typical bond aggregate indices. So it's a great move. It's a great conversation. It's a great way to boost up returns and also protect wealth when you're thinking about some of the volatility that's going on in the spring here of 2026. Tim, you took away my closing points of this entire series, which was really about focusing on outcomes and making yourself more referable by really giving good quality education about annuities and also then executing on that inside of the portfolio. I think that that will improve the outcomes if done properly. And when you improve outcomes, you said it, nail on the head there, you will become more referable. But as we wrap up this series with Fisher Investments, what would be one or two sentences that you would tell advisors relative to the use of annuities inside of portfolios?
I've said this in other episodes. Take away the bias and dig into the solutions that are enabled by owning annuities in the right way, the right type, the right way. And we've talked about QLACs and indexed annuities, deferred income annuities. We've talked about, this is our 18th episode. And if by now, we do not have a bias towards annuities, we say if they work, then use them. I'm also going to say this: I eat my own cooking. I own many of these solutions that we talk about for my family. I've also have been fortunate enough to have my wife and I have a foundation. We use MYGAs inside the foundation. So when we're distributing the 5% that we need to, we have a solution to do that. So what I would say is contact our retirement income consultants. Say, I just want to learn more. Educate me so I can further help my clients live a better retirement and live one where they don't have to wake up at 3 a.m. wondering, am I going to run out of money? So those are my closing remarks, and thank you for asking. Appreciate the advisors tuning in.
As you were talking, I just wrote down one of the things that you said several years ago that I've always tried using. we're in the business of solutions and not sacrifices. I always like that line. And at the end of the day, that's what an annuity allows you to do. It's not a sacrifice. You're not locking money up. You are providing a solution, not a sacrifice. So, Tim, thank you very much for your time, especially over the last 5 weeks as we dive into this Fisher Investment Annuity Insight. We will be back with more episodes. As Tim indicated, if there's something that you would like us to talk about, please let us know. Feedback, we appreciate it. But most importantly, we appreciate you listening. And if you like what you hear, make sure that you like and subscribe. Thank you for listening.
This episode of Accumulation to Activation was produced by Ash Brokerage. For more on the most pressing and critical issues facing financial advisors today, be sure to subscribe, leave a review, and share this episode with a colleague. For more resources, visit us at ashbrokerage.com or reach out to our team at 800-589-3000. Let's start a strategic conversation about how you can be more efficient with your retirement income and legacy planning solutions. Insurance product guarantees are subject to the claims-paying ability of the issuing insurer. Annuities are insurance contracts and may be subject to fees, surrender charges, caps, spreads, participation rates, and tax implications. Withdrawals are taxable and, if taken prior to age 59 and a half, may be subject to an additional tax. Product availability and features vary by state and carrier. Social Security and tax rules are complex and subject to change. Clients should consult their tax and Social Security advisors. Any modeling or Monte Carlo analysis referenced is based on stated assumptions and are illustrative only. Results vary by client profile, market conditions, and product selection. Past or modeled results are not guarantees of future outcomes.